There is a number that does something different. Not because of what it buys, not because of what it looks like in your account, but because of what it does to the way money itself starts to behave. That number is $100,000. Charlie Munger talked about it directly. He said the first $100,000 was a botch, his word, but that you had to do it. He told young people to focus on it with everything they had, because once you cross that threshold, something fundamental shifted. He was right. And in Australia in 2026, that shift is more consequential than ever. Here is what actually changes. First, understand what you have built. Most Australians never get here. The average savings balance in this country sits around $42,000. That means if you're sitting on $100,000, you have already done more than most people will do in their entire financial lives. Not because you are smarter, not because you got lucky, because at some point you made a decision and you held it. That matters. Not just financially, it matters because it tells you something about yourself that you now carry forward permanently. You know you can do hard things with money. That knowledge is worth more than people realize. But here is the danger that comes with it. A lot of people hit $100,000 and freeze. The number feels too significant to risk. It sits in a savings account earning 5% while they think about what to do. And thinking becomes waiting, and waiting becomes years. Munger had a phrase for this. He called it the pain of doing nothing masquerading as caution. The account looks full, but purchasing power quietly bleeds out every single month. So the first thing that changes at $100,000 is that indecision becomes expensive in a way it simply was not before. Then understand what the money starts doing on its own. Warren Buffett described compounding as a snowball rolling down a hill. The critical insight is not the snowball itself. It is the hill. You need enough snow and you need a long enough slope, and then the process takes over in a way that feels almost unfair to watch. $100,000 is enough snow. At a 9% average annual return, roughly what broad global equity markets have delivered over long periods, $100,000 becomes $236,000 in 10 years without you adding a single dollar. In 20 years, it becomes $560,000. In 30 years, it crosses $1.3 million. You did not earn that last million. The money earned it. That is the shift. Before $100,000, you are the engine. Every dollar in the account got there because of your labor, your time, your showing up. After $100,000 deployed correctly, the money starts to become a second engine running alongside you, quietly, constantly, without needing sleep or motivation or a good week. Buffett has said that his wealth is almost entirely the product of time and compounding, not genius. He started early, he picked good assets, and then he waited. The waiting is the hard part, and the waiting only works if the snowball is big enough to matter. $100,000 is big enough to matter. Now let us talk about what that looks like in Australia specifically. The two most powerful vehicles available to an Australian with $100,000 are ETFs and superannuation. Not property, not crypto, not a business idea a friend mentioned at a barbecue. For most people at this stage, these two things done well will outperform almost anything else on a risk-adjusted basis. On the ETF side, the structure is simple. VAS gives you exposure to the top 300 companies on the Australian Securities Exchange. IVV puts you inside the USS&P 500. VGS spreads you across developed international markets. A combination of these three gives you ownership of thousands of companies across the global economy for a management fee that is almost invisible. You are not picking stocks, you are owning the economy. And over the long run, the global economy has gone up. Buffett has said repeatedly that a low-cost S&P 500 index fund will outperform the vast majority of professional fund managers over 20 years. He put real money behind that claim. He won a decade-long public bet against a hedge fund to prove it. The principle holds in Australia. The question most people ask is whether to invest the full $100,000 at once or spread it out over time. Dollar cost averaging, than putting in a fixed amount each month regardless of market conditions, removes the psychological burden of timing. You buy more units when prices fall and fewer when they rise. Your average cost smooths out. And more importantly, you remove the decision from the equation. It becomes automatic. Automatic is powerful because it defeats the version of you that panics in a down market and freezes in a rising one. Then there is superannuation, and most people under 40 are ignoring it almost completely. The concessional contribution cap for 2025 to 2026 sits at $30,000 per year. From July 2026, that rises to $32,500. Money you salary sacrifice into super is taxed at 15% instead of your marginal rate, which for most working Australians sits at 32.5 or 37%. That gap, the difference between 15% and 32.5%, is not a small accounting detail. It is an immediate, guaranteed, government-sanctioned return on every dollar you direct that way. No market movement required, no timing needed, just the decision to use the structure that exists. And if your total super balance was under $500,000 at the end of the last financial year, you can carry forward unused concessional contributions from up to 5 prior years. For some people, that means the ability to contribute well above the standard annual cap in a single year, with the full tax deduction attached. Barely anyone uses this. It is completely legal, and it sits there waiting. Munger was a lawyer before he was an investor. He talked constantly about the importance of understanding the structures and incentives of whatever system you operate inside. The Australian superannuation system, for all its complexity, is genuinely structured to reward people who understand it. Understand it. Here is what the $100,000 moment is really about, underneath all the numbers. Buffett has a concept he calls the inner scorecard. The idea is that the people who make genuinely good long-term decisions are guided by an internal standard rather than external validation. They do not invest because a forum is excited. They do not sell because the news is frightening. They have a framework, they trust it, and they execute it regardless of the noise around them. Getting to $100,000 in savings, especially in Australia in 2026, when rent alone can consume half an above average income, requires exactly that quality. You had to tune out a version of life that was available to you and choose something harder and slower and less visible to people around you. That is the inner scorecard working. That discipline does not disappear once the money is deployed. It compounds too. The people who grow $100,000 into genuine wealth over 20 years are not the ones who found a clever shortcut. They are the ones who understood what they had, set it up properly, and then did the most underrated thing in personal finance. They left it alone. So what actually changes after $100,000? The math changes. The psychology changes. The relationship between your time and your money changes. Before this number, every dollar in your future required a dollar of your labor. After this number, correctly deployed, some of those future dollars will arrive without you lifting a hand. Not all of them, not most of them, but some. And that some grows over time into something that starts to feel like freedom. Munger said it plainly. Get to $100,000. Do whatever it takes. Live smaller, earn more, cut harder. Because on the other side of that number, the game changes. He was not being motivational, he was being mathematical. The snowball needs a critical mass before the slope does the work. $100,000 is that mass. You have got the snowball. Now find the slope and get out of the way. If this gave you a clearer picture of what that number really means, hit the like button. It helps more Australians find this content when they need it. Subscribe if you are not already, turn on notifications, and I will see you in the next one.